Welcome to the Max Dividends channel, where we help people build growing passive income, retire early, and live off dividends. In every Academy case, we take one stock and run it through the same checklist so you can see step by step whether it really deserves a spot in a serious dividend portfolio. Today we're examining Lockheed Martin, ticker LMT, a global leader in aerospace and defense systems that sits at the heart of deterrence, readiness, and allied security priorities. We'll answer, how does this company make money? Is it a good stock to hold long-term? We'll walk through the Max Dividends checklist, test its financial condition with the 5-pillar secret formula, see what role it plays in a dividend portfolio, and finally ask if LMT is attractively priced today. How this company makes money. First question, do I clearly understand how Lockheed Martin earns its money, and does that business model make sense for dividend investing? Lockheed Martin designs and builds advanced defense and aerospace systems. But the real compounding engine is the combination of a massive installed base already fielded with the US and allied militaries and a long-tail sustainment and modernization ecosystem that supports, repairs, upgrades, and supplies parts over decades. Cash flow is driven by procurement demand across budget and threat cycles, plus the high-value aftermarket-like stream that comes from keeping platforms mission-ready, not by consumer branding or product fashion. The core earnings drivers are platform leadership and installed base. Each new delivery expands a fleet that needs maintenance, spares, software updates, and eventual modernization, turning procurement cycles into long-run service revenue. Sustainment ecosystem, logistics, depot and field support, parts availability, and deeply embedded customer relationships create a moat that supports program position and aftermarket capture even when budgets tighten. Parts, spares, and modernization, steadier demand than new production because keeping high-end platforms ready is non-optional, with razor and blades dynamics that improve cash flow quality and customer stickiness. Execution discipline and capital allocation. Program risk control, supply chain discipline, cost productivity, and thoughtful capacity decisions drive through-cycle cash generation, while Lockheed keeps investing in engineering reliability and customer support. In other words, Lockheed Martin is not a black box. It's an installed base and sustainment ecosystem built on readiness, customer integration, and lifetime program economics. Exactly the kind of structure that can support a long dividend record when paired with conservative financial management. Is this a good stock to buy long-term? Step 1. Dividend history. Our filter is simple, at least 15 years of consistent dividend growth. Lockheed Martin doesn't just clear that bar, it displays the classic stair-step dividend pattern long-term investors want, despite operating in a business exposed to program execution risk and shifting budget cycles. Annual dividend per share climbs from roughly $3 in the early 2010s to about $13 or more in recent years, with no visible reset or panic cut. That shape signals a payout backed by repeatable cash generation and a culture that treats the dividend as a core commitment, not something adjusted opportunistically when conditions feel comfortable. Step 1 passed. Lockheed Martin behaves like a genuine dividend eagle with a durable record of increases that supports its candidacy as a dividend growth holding. Step 2. 5-pillar secret formula. First pillar, sales growth, the foundation. On a 10-year view, Lockheed Martin's sales grew from roughly the mid-$47 billion range in the mid-2010s to about $75 billion most recently. The path isn't perfectly smooth, and it shouldn't be for a company tied to defense budgets, program timing, and delivery cadence, but the long-term direction is clearly higher. The uneven patches are the stress test. When procurement timing shifts or program mix changes, revenue can move around. The key is that LMT continues operating from a larger revenue base than a decade ago, showing the franchise is durable. Sales growth passed. Lockheed Martin now operates off a much larger revenue base than a decade ago, which supports dividend growth. Second pillar, profit growth. The fuel, profit trends reinforce the same message with added conviction. Over the last decade, profits build from roughly the mid-$5 billion range to around the mid-$7 billion range most recently. With the path including a rise into the late 2000s, followed by a choppier stretch and then stabilization. The driver is not a new fad segment, but better economics on a growing installed base. Sustainment penetration, contract execution discipline, and ongoing cost productivity. That looks durable rather than dependent on a single perfect year. Profit growth past. A resilient profit base protects the payout and funds future increases. Third pillar, net income, true strength. Net income sits around the mid-single-digit billions for much of the decade, reaching roughly the $6 to $7 billion range at stronger points and easing back toward about $5 billion in the most recent years. The profile includes a noticeable early dip, a rebound to a higher earnings zone, and then a choppier stretch. Exactly what we want to see in a cyclical business. Evidence the company can absorb volatility and keep the underlying earnings engine intact. Net income past. A resilient underlying earnings profile reinforces that LMT's dividend growth is supported by real operating staying power, not a temporary tailwind. Fourth pillar. Dividend payout safety, protecting passive income. For most of the period, Lockheed's payout ratio sits in a reasonable band, often clustering in the 40 to 60% zone for a mature defense contractor focused on shareholder returns. Then you see an outlier, a one-year jump to just above 100% before the ratio drops back and resumes a normal band. That spike happens when earnings take a temporary hit and management keeps the dividend on its planned path. The denominator weakens, not the dividend commitment. What matters is what comes next. The payout ratio normalizes back into a sustainable range as earnings recover, showing coverage has been restored. Dividend payout safety past. Despite a temporary distortion during an earnings dip, the payout ratio has returned to a sustainable range, supporting the view that the dividend is affordable under normal conditions. Fifth pillar, debt burden, avoiding traps. Lockheed uses debt, and that's expected in a capital and R&D intensive business with long program timelines. The 10-year debt ratio stays in a broadly managed band, generally in the high 0.8 AS to around 1.0 early, dipping to roughly 0.78 in the middle years and settling back near the high 0.8s more recently. That's managed structural leverage, not a creeping problem. Debt burden, leverage is on the high side and the main constraint to monitor, but the stability of the ratio across the cycle reduces the odds of near-term dividend pressure. Lockheed Martin's overall financial score comes in at 98, very safe in our framework, signaling a balance sheet and earnings profile built for durability across multiple macro environments. Does it fit our plan? This is where we move from, is it a good company, to what job should it have in my portfolio? MaxRatio combines three signals: current dividend yield, dividend growth, and financial strength, to classify stocks as growth eagles, balanced eagles, or income eagles. Lockheed Martin's MaxRatio is 4.27, which places it in the balanced eagle bucket. With a dividend yield of 2.24%, LMT offers meaningful income today without leaning into high-yield territory. The appeal is in its overall profile, approximately 36% cumulative dividend growth over 5 years, a 5-year average payout ratio of around 52%, and a multi-decade dividend record that reflects management's commitment to shareholders through program and budget cycles. In practice, Lockheed Martin is a balanced core holding, a solid starting yield designed to grow over time as the installed base expands, sustainment capture improves, and management raises the payout in line with through-cycle cash generation. It fits investors who want steady dividend compounding from a high-quality defense franchise and can accept some program-driven earnings variability along the way. Is the stock undervalued today? Versus peers, LMT screens as undervalued in the Max Dividends app, meaning the market currently assigns it a cheaper than average valuation relative to comparable aerospace and defense names based on its current profit profile. Versus its own history, the current PE is around 30 versus a 10-year average near 21.53, which suggests the stock is trading at a premium to its own historical multiple, even if it looks cheaper than peers today. On yield, LMT pays about 2.24% today versus a long-term average near 2.89%. so the starting income is still below what investors have typically received over the last 15 years. Analyst consensus sees only modest upside over the next 12 months, with an average price target implying roughly 1.85% upside and a wide range that reflects real uncertainty around program execution and budget timing. Final decision. Taken together, Lockheed Martin looks like a high-quality dividend payer that is discounted relative to peers but still priced above its own long-run average multiple, with a yield that is improving but still below its historical norm. That can still work if your goal is long-term dividend compounding and you value a durable defense franchise with a shareholder-friendly policy. For conservative dividend investors, LMT makes the most sense as a balanced eagle you hold for the long run. A solid starting yield paired with a proven dividend culture and the potential for that 2.24% to grow steadily as Lockheed keeps executing through procurement cycles and installed base expansion. Subscribe for more analysis. This is not investment advice.